Good morning, good evening, wherever you may be, whether you're tuning in across the nation or around the world. My name is Shane Squark, and on behalf of the CMT Association, I'm pleased to welcome you back to another episode of our educational web series. Today, I am pleased to welcome Ryan Gorman, CFA, CMT, BFA, Sean Keel, CFA, CMT, and Vincent Randazzo, CMT, to the program to present Rethinking Risk Management and the myth of missing the best days. As always, we welcome you to submit your questions throughout the duration of today's presentation using the chat box on the right-hand side of your screen. In the interest of time, however, we may not be able to acknowledge all of your questions until the end of the formal presentation. Your participation in today's live webcast does qualify you for 2 CMT Association continuing education credits, which will be automatically added to your account if you registered online through the association's website. And with that said, I am pleased to turn the floor over live to our presenters.
Great. Thanks, Shane. Hi, everybody, and welcome. We appreciate you taking the time out of this sleepy summer afternoon to join us in today's session. What if missing the best days is missing the point? I thought that was just such a great header for the session, and we're really excited to join and to dive into this topic, essentially in determining the true value of buy and hold and dispelling some of the myths around its legend, if you will. So I'm Vincent Randazzo. I'm a charter market technician since 2008 and the founder of ViewRight Advisors. Some of you may also know me from my time at Lowry Research, working with Paul Desmond, of course. And I'm happy to be joined by Ryan Gorman and Sean Keel, friends and fellow CMTs who I respect for their depth of thinking, and I'm proud to have partnered with them in this research and development of this project because they are smarter than me. Ryan is a dual threat CMT CFA, in addition to being the Chief Investment Officer of West Michigan Advisors, Tamarisk Multifamily Office, and Tamarisk Research. Sean is another one of those CMT CFA holders and was basically the quantitative engine for our efforts here. So we thank him for that. He's a portfolio manager and principal quant strategist at QN Capital Analytics and World Source Securities. If I said that right, Sean, you can correct me later. Yeah, okay, good. So just a little background on how this all came to be, how we met, and we all live thousands of miles away. Sean's in Canada, Ryan, of course, is in Michigan, and I'm in Florida, and we've never worked with each other professionally. So how did this happen? So it's kind of an interesting story, and it's all rooted in the CMT Association, which I think is great. Ryan and Sean first met in person at the 49th annual CMT Association Symposium, and I think that was in 2022, after connecting on LinkedIn with both, holding those CFA, CMT designations. I'm sure it didn't take long for them to hit it off and stay in touch, of course. Now, Sean and I actually go back further. Now, believe it or not, I sponsored him for his CMT many years ago. And at that time, I was in the early stages of developing what would eventually become the system behind ViewRight Advisors. And I always remembered his analytical rigor. So about 8 months ago, I reached out to get his take on some of the work I was doing. And a couple months later, I connected with Ryan, and we had been sort of familiar with each other through LinkedIn posts, having sort of similar mindsets. You can sort of tell that sometimes with content people put out on LinkedIn, and my work at Lowry. And after a few conversations, it became clear that we shared really a well-aligned perspective on markets and particularly risk, and some of the behavioral traps that investors and advisors even often fall into. Now, the real spark, I guess the final catalyst maybe for this project came at another CMT Association event. That's this past February's midwinter retreat in Tampa. And that's where the three of us finally met in person. And after a few conversations throughout the event and fittingly over a few drinks at the hotel bar, we found ourselves ranting in a, I would say friendly, of course, data-driven way, very respectful, about the persistent missing the best days narrative and how kind of annoying that was. And like any good team of technicians, our best ideas tend to come from the intersection of charts, finger foods, ideally free finger foods, and cocktails. And this was no exception, of course. So the week after the retreat, Ryan officially floated the idea of writing the paper to debunk the myth, and not just from a theoretical standpoint, right? But from the practical lens of advisors and clients. And what started as a shared frustration turned into a deep dive into the risks this narrative ignores and how it ultimately disadvantages both advisors and investors, not only financially, but I think psychologically, which of course is hard to measure. Now, I'm going to go back a couple slides here because I think we're a little out of order here. So that brings us here, to the challenge of a piece of conventional wisdom that you've heard too many times, which goes something like this: the cost of missing the best days in the market is too high, so you just have to stay fully invested no matter what. Now it's catchy and they say it with a lot of conviction, but when you dig deeper, like we did, you realize it's also dangerously incomplete, costly, and certainly outdated. So this webinar was built around that paper, of course, which we co-authored, Rethinking Risk Management and the Myth of Missing the Best Days. That was in the latest issue of Technically Speaking, if you want to take a look at that. In it, we just take apart the assumptions behind that narrative and show how advisors and investors might be internalizing the wrong lessons. So we're going to get into this in a lot of detail in a minute, but I just want to share with you, some of the highlights that we found. We'll sort of drill into those. Number one, the best days almost never show up in healthy bull markets. All right, I think that's important. Number two, these quote unquote best days are often just reflex rallies inside bear markets, and really hardly the kind of conditions you want to be exposed to. Just getting to that point, certainly, but even at that point, right? And then finally, when it comes to the prospect of long-term wealth building, the ignored sequence of return risk and volatility drag, matter a lot more than just catching those isolated daily gains. So we're going to show you why a systematic, what I would call a risk-aware approach can not only sidestep the pain of the drawdowns, but also enhance the long-term compounding and confidence in the investment process. So if you are an advisor, if you are an RIA, or even if you're just an investor looking for a more resilient path forward, or someone like us who's just tired of the, ride it out mantra, I think you're going to find this conversation refreshing and also actionable. But I wanted to start with Ryan. Let's get started with what he has. He's going to start by taking us through sort of why are we doing this in terms of like where the rubber meets the road on a client basis, and then some of the biggest flaws in the best days argument. And then Sean, after that, is going to follow with some of the numbers he had crunched and some of what that means. So with that, I'll hand it over to Ryan. I'll get you on the proper slide here, Ryan. All right, there you go.
Great. Thanks a lot, Vince. As Vince mentioned, that study and the idea that missing the best days. I mean, I feel like if you go through LinkedIn or X, you can't almost go a month without seeing somebody cover that. And even Cliff Asness of AQR recently said that myth is perpetrated by people that should know better. But before we dive a little bit into how those studies may be misleading, let's talk a little bit about why we think that this is important. So here's a hypothetical. This portfolio is just created as a retiree portfolio. It's 55% in the total U.S. stock market, 15% ex-U.S., and 30% in bonds. And what happens if you have $1 million portfolio? You take 4% a year, which is $40,000 to start. What happens if you retire in 1995? And so some of the studies that we did were to the mid 90s, just to give the example of a roaring bull market, a really good returns at your back. And what you find is that running this through recently, you've been taking your $40,000 a year, you've got almost $6 million bucks. You're feeling pretty good, even though you've had a drawdown of closer to 41%. But when you're still accumulating and compounding wealth, it's probably a little easier to roll with those punches. So let's take a different example. What if we retire in 2008? Obviously, this would be really poor timing if you remember history. Same portfolio, taking $40,000 a year. The ending balance then is a little over $1.5 million. It's $1,744,000. So the returns go way down. The drawdowns are roughly the same. And while this client would still be successful, you also have to say if the portfolio is well below the principal level, there's an emotional fear and stuff that Vince kind of spoke about. And if you've been in this industry working with retail clients or even with your own money, that it's a lot harder to stick with it than what the back tests would show. And so, even though this is a successful outcome, we'd have to imagine the probability of selling low or bailing out because I just can't lose anymore was a real risk if you were unlucky to invest at that time. And history has shown that there's, while most of the time the market goes up, there are lost decades. And depending on when you want to retire, it could have a profound impact on that. So this is one of the real motivations of what we wanted to talk about with dispelling this is, to be good portfolio stewards, to manage risk. It's not about market timing, but really trying to make sure that you get the best possible outcomes. So with that, one of the things that this study does is you basically, from my understanding, you take the daily returns. This was found, you can go to Yahoo Finance and get the daily returns, and you rank sort them by the largest daily returns. You delete them, you re-rank them by the date again, and now you recalculate the returns. And as you can imagine, that's really kind of misleading because it's almost like a coin flip each day. Heads the markets up, tails the markets down, and you get some sort of returns. And so that math just kind of ignores a lot of real important things about how the market is structured. And so as an example, obviously 2008 was a pretty big decline. Here we have the 200-day moving average. But what I wanted to illustrate here is that you're ignoring the pathway of returns. And so if you were to, for instance, sell at the 200-day moving average somewhere around here when it broke, and you don't buy again until here, it doesn't matter that these green boxes, these are 3 of the biggest up days in the last 50 years. Some of these red boxes here were the biggest down days. They're all happening here. If you've sold out here, it really doesn't matter. So I often say the only thing that matters to your returns is the price that you buy something at, the price that you sell it at, and any income in between. The rest of it, what happens while you're in cash is essentially noise. And when you just rank sort the days and delete them, you're ignoring that pathway. And I think that's really the part that's somewhat disastrous about viewing the market in that lens. So if we dive even a little bit further with this data, so as I illustrated, it's below the 200-day moving average. We look at trend following in a couple of different ways, going back to 1994. We either use the 200-day moving average, which is a very common, Medfaber, AQR, a lot of firms have done studies on that. We also used a 12-month rate of change. We are big fans of momentum, and so if the rate of change over the last 12 months is negative, that's a sell signal. And so if you look at the world in that lens, we find that the best and worst days, two of the best days in the last 30 years and one of the worst days occurred in a positive regime, meaning you're above the 200-day moving average or have positive momentum. And for the most part, they happen below. And that's where we found, well over the majority of them kind of occur in this area where you're looking at negative trends. And so that's the inspiration of Paul Tudor Jones. He's famously said nothing good happens under the 200-day moving average. That is totally consistent with the data that we found. And therefore, if you're using some of those metrics, like we'll show shortly, that in itself can help save some of the returns and the risk. So the other side of the coin is, most of the studies, they show you, and we replicated it here. The red line is over that time period, we're going to go in and delete the best days. Your return from a base buy and hold is, let's call it 8%. Standard deviation is pretty close to 20. I mean, those are pretty textbook. Over 100 years, it's about 8% and 20% volatility. That's been pretty consistent over time. If you miss the 20 days, though, your returns go to 2.77, and the volatility, kind of remains about the same. So that tells a huge story. Oh, yeah, don't time the market. You're absolutely destroying your returns if you miss those days. But what happens then if you, by the same math, and most studies that I see, perpetrated online, they don't include what happens if you miss the worst days. Well, your returns go way up and standard deviation goes down. And so kind of the argument says, hey, even if you're using the same misleading math, you're only telling half of the story. So that kind of leads us to some ideas of, okay, so now we know that the math is misleading and there might be some benefit from managing risk. Where do we go from here?
All right. So this chart shows the distribution of the S&P 500 prices when above and below the 200-day moving average. As we had mentioned, is a common indicator for identifying market trends. So the daily returns, when the index is above the 200-day moving average, the green histogram tends to be centered around positive average with less variability, where returns are below the 200-day, which is the red histogram, show more negative average and fatter left tails. These findings confirm what technicians and quantitative strategists have long observed. Market behavior changes over time, and the return distributions depend on a regime and path. So the importance of this chart lies in the direct challenge to missing the 10 best days fallacy. If extreme upside and downside volatility tend to occur more frequently around downtrends, then trend-aware approaches, such as filtering exposure using the 200-day moving average, can enhance not only raw numbers, but also risk-adjusted performance by mitigating left tail risk. Essentially, the distribution analysis reinforces the main point of our paper, which is context matters. Instead of removing best and worst days in isolation, as Ryan had mentioned, investors should understand that these days often occur in volatile environments, and staying out of the market during poor regimes can lead to better long-term results without needing to predict individual days. So the next slide is the positive versus negative 12-month momentum. So the chart distribution, again, looks at the 12-month momentum, daily returns, distributions based on 12-month positive momentum, the blue histogram. The returns outcomes were skewed positively with a tighter spread around higher averages. Conversely, the period with negative momentum, the orange histogram, displays a wider spread, notably lower averages and increased downside tail risk. These behavioral shifts are not random noise. They reflect a risk regime change where market structure and investor sentiment influences volatility cluster and asymmetrical return profiles. So the value lies within these charts is emphasizing solid statistical principle. Momentum predicts not only direction, but also distribution shapes. By analyzing market behavior through trailing returns, we show high momentum regimes often favor risk reward profiles, while low momentum regimes present greater downside risks. This supports our view that market timing studies should include path-dependent measures, strategies that adjust exposure to low momentum conditions, not by avoiding best days, but by navigating trend declines. With that, you can significantly better long-term and risk-adjusted results. And then, so in this table here, I just ran buy and hold over the 1997 to 2023, and then just took trades above the 200-day moving average, below positive momentum, and then I did one with combining the two together, just as another factor to support our paper. So the buy and hold yielded 9.3, but it always 100% invested. However, that 100% invested comes with significant cost, which is maximum drawdown of 55% and an annualized volatility of nearly 20, with a poor Sharpe ratio of 0.32. So it highlights the psychological toll of passive investing, complete exposure to the market crashes and uncertainty, with only modest rewards for the risk taken. Now, if we compare that to the 200-day moving average, the returns do drop to just under 7. The risk adjusted improves slightly due to the lower volatility and drawdowns. The Sharpe ratio increases to 0.42, and the drawdowns are reduced by nearly half. Notably, the beta is only 0.38, indicating the strategy participates much less in market volatility. As for the 12-month momentum, not that much lower than the buy and hold. But again, we drop max drawdowns by almost 50%. Sharpe increases to 0.56, which is excellent. And then in the combined, drops slightly. We're not in the market as much. Again, max drawdowns are a little over half, and Sharpe is still respectable at 5.2 versus the 3.2. And then Vince.
Yeah, thanks. Thanks, Sean. So let's get into how we can go beyond the simple trend following systems like the 200 moving average or the 12-month momentum, and into sort of the next advancement here. Now, these tools are obviously effective. We just showed that. They clearly, improve the risk-adjusted returns by sidestepping the worst parts of bear markets. But what if we could, refine these approaches further while really, I think, focusing on, the market bias that market generally tends to trend higher over time. 75% of years are positive historically. But also B, minimize whipsaws, because I think that's something that a lot of people really dislike, and certainly I do in my career, and I've always had issues with them. So what do we do here? And that's where Defender comes in. Now the Defender program is a systematic risk management overlay, and it's based on market breadth, which to me, very unlikely to lie to you at any given time, because it is just so simple. Us technicians know about breadth and just how simple it is. And because of its simplicity, and the limited amount of human manipulation, it tends to be really trustworthy. The trouble is now trying to wrangle it in a way that you can make a system around it that's actually timely, right? So I developed this system based on my own 25 years of experience in dealing with advisors and institutions, learning from not only their mistakes as well as my own, right? I mean, we all make our own mistakes, and those are the best lessons. You can also, learn lessons if you're smart enough by watching other people make those mistakes. But I think when you make your own mistakes, then you're able to learn a lot better because they're more painful in your mind, psychologically. So that's kind of how I set out to build Defender and why I did it. And rather than relying on, this is really one of the differences here is, rather than relying on a single, binary trigger, either, to get out of the market completely or to get into the market completely, it's just not how people invest now. Even if they wanted to, I just don't feel like you could. And this has been a frustration of mine for years, just being in sell side research, where that's sort of like an unspoken, untalked about rule as far as this implementation side of things. We give these signals that say sell, but what does that really mean in terms of how do you actually incorporate that in a real life scenario? So that's why I built Defender the way I did, which uses a layered, graduated approach within the context of a rules-based system, and it's built from over a century of market cycle analysis. And like I said, it scales out ahead of and then coincident with weakening in risk reward regimes. So it doesn't react to any headlines. It really just responds to structural deterioration in market internals. So really nothing we could even see in price. And in fact, at tops, you usually don't see this. You don't see this in price until it's really too late. So the idea is that when fewer stocks participate in rallies, Defender gradually reduces exposure because it recognizes the fact that this means that there's less breadth. So as a portfolio manager, it's much more difficult to pick stocks that are going up, and even more difficult to pick stocks that are outperforming. And again, it doesn't go all out unless that deterioration reaches critical mass. And again, there are sort of proofs at every point. It's a third, a third, a third. And if there are proofs that gets you all the way there, then you could go to full cash. It is just really rare. And then if a genuine recovery begins, and that would be supported by breadth and momentum, Defender is designed to reinvest early and with high conviction. So in that case, because you have this asymmetry between expected return and risk, and with the understanding that the market most of the time goes up, there's sort of a bias to push back in, and in that way we do make it binary. It is a full push back in, just because that's how the markets are built over history. And the result, when you look at the results, you have nearly 60% less median drawdown during bear market regimes, which is a meaningful improvement, even over the standard trend filters that we just talked about. Now, when we talk about comparing these three approaches, right here we're comparing buy and hold, basic trend following, like the percentage stocks above the 200-day moving averages, and then the 12-month momentum, and then of course the Defender strategy. And what I think stands out is that despite missing many of the best days, if not all of them, both the Defender and the trend filters outperform buy and hold over full market cycles, not just in returns, but also in drawdown control and in consistency. Defender here captures sustained uptrends while sidestepping deeper sell-offs, and that leads to, of course, mathematically smoother compounding and lower volatility, especially in prolonged downturns. Now, even though we gave, you might ask about the start point here, 1997. So we did that to give buy and hold the advantage, right? So you can sort of advantage it into the late 90s and the dot-com boom. And even if you do that, you still see that there's just this huge benefit to navigating risk. That's really the bottom line here, is that there's just huge benefit to just stepping out of the way. And as technicians, if we can see that train coming down the tracks and it's about to hit us, then we might as well just step out of the way, and we can always get back on the tracks. So I think here, the point here is that what matters isn't capturing every best day, but avoiding the prolonged negative trends, which these systematic filters are designed to do, right? I mean, that is really the primary point here. And I think it just goes, feeds more into that myth and why it is really misleading. Next, this gets a little bit more into the risk-adjusted aspect of this. The final slide really drives home that point of just the defender's strength. This chart's really the foundation of the argument in terms of it being able to tie together both the risk-adjusted performance and the drawdown control of each of these investment approaches over time. And in the top panel, I know it's a little hard to see on the chart, but you'll get this. You can sit at your desk and read through it. In the top panel, you can see how buy and hold experiences these just really erratic shifts in the Sharpe ratio, really high in bull markets, but then collapsing, of course, during crises, right? Meanwhile, both the 200-day moving average and the 12-month momentum filters produce more stable, elevated Sharpe ratios through most periods. And then the defender strategy, which combines these trend filters with a rules-based overlay, consistently delivered the best risk-adjusted returns if you look at the bigger set of data here. And I think this is really important because it highlights not just performance, but the consistency and smoothness of returns, which is a major driver of real-world investor experience and what I would call, behavioral success, right? Not feeling terrible at any given moment and sort of not doing, as a result of that, doing the wrong thing at the wrong time. Then in the bottom panel, we see the rolling 12-month drawdowns. And this is where passive investing's vulnerabilities are really laid bare out in the open. I mean, this makes it really, really clear. Periods like 2000 to 2002, 2008, even 2022 show extreme drawdowns for buy and hold. And those periods are often going to test an investor's emotional discipline and their psychological boundaries in terms of what they can accept and what they can't accept. And that's sometimes you find out too late. A client will say, yeah, I can take risk or I can handle it. And then this happens and they can't. And that's normal. That's human behavior. And that's why we have systems. But Defender and to a slightly lesser extent, the two trend filters cut those drawdowns significantly. And more importantly, and I think this is the key when it comes to that compounding equation, you recover much faster, right? And this also has a meaningful psychological implication in terms of reducing the pain felt during the drawdowns, and that helps them stay invested in our within a rational, systematic frameworks when we have them. The other point that's worth mentioning that you can't accurately quantify is really just the value of sleeping well at night and not seeing your life savings get destroyed every few years, seemingly without reason. Not only how that feels, but what those feelings, like I said, can cause you to do, like sell at the bottom. And I'm sure we all have clients that have done that or done something close to that, and you can see what the long-term effects are. Now, I would say these rolling charts really visually enforce the thesis that it's not about predicting the market, and this is really important. It's about adapting to the market regime. So again, putting the market in the ultimate place of respect and adapting to what it is telling us, not the other way around, which market timing does is it's basically saying the market should be doing this, therefore we're calling this or calling that. And I would say that regime-based filters, as we've seen here, lead to better risk-adjusted returns, shallower drawdowns, and ultimately a more survivable, what I would call survivable and scalable investment experience, for you as the advisor, and also for your clients who have to live through this. They're novices when it comes to this. You're professionals, but it still is tough, and hand holding takes you away from building other client relationships, bringing other clients in, and of course managing the portfolios themselves when you have to do those things. So in conclusion, and bringing it all home, and I think the takeaway here isn't just that the missing the best days stat is flawed. It's that relying on it can lead investors and advisors to make really dangerously oversimplified decisions. And most of those so-called best days happen during bear markets, right when risk and volatility are peaking. So is the idea that staying fully exposed to capture them the safe or smart thing to do? I mean, it really, again, it just doesn't hold up to real scrutiny here, right? And I think more importantly, this isn't about, like I said, market timing or crystal balls, or we have all the answers. It's about, portfolio stewardship, about managing risk systematically with a plan, so that we can sidestep those deep drawdowns, stay emotionally grounded, and keep compounding intact throughout the cycles. So I think if we work on shifting the conversation away from the fear of missing out and toward the probability of long-term success, both advisors and client outcomes are going to be that much better. So I'll leave you with this. The next time someone tells you the worst thing you do is the best market days, feel free to tell them that actually that might be missing the point. So thanks for spending this time with us today. We hope you gained a little bit different perspective on this, and a few tools you can take back to your practice and your portfolios. But with that, we're glad to take questions.
All right, thanks. I see a couple of the questions have come through here, so I'll grab one here. Question is beyond. So the question was, beyond the 200-day moving average and 12-month momentum, are there other metrics or techniques that you're exploring to enhance trend following models? So I think Vince kind of covered on using breadth and some of that stuff is an area a lot of technicians use. We wanted to use, Gary Antonacci talks about 12-month rate of change, which is what we used for this study. So the 12-month momentum is 12-month rate of change. If it's positive, you're invested. If it's negative, you're out. And then the 200-day moving average is for the other trend following system. One thing that I personally found is that if you wait until the end of the month, that can sometimes, you only trade at the end of the month. If you're below the 200-day moving average, that can reduce whipsaws. And the other thing that I've played around with is, say, obviously you kind of have to adjust the look backs depending on your investment universe, small caps being more volatile, et cetera. But I found, using like a 126-day moving average, which is half a year trading, and then a 252-day moving average, if you wait for a monthly close below both of them, that's the risk off sign, but then you use the quicker moving average to get back in. So there's a lot of different ways that you can play with these. And, on the one hand, you got to find what's going to work for you, but you don't want to overfit. But I think the biggest thing with trend following is whipsaws. So coming up with ways to, not get in and out in a small period of time, and perhaps get in faster when the new trend emerges, is something that I've personally done some research on.
Yeah, thanks. I see another one specific to, question on Defender, so I'll take that. The question is, how does Defender compare during sideways or range-bound markets where momentum or trend signals are unclear? Yeah, it's a good question. The best example of that actually is in the last secular bear market, so 2000 to 2013, where you basically compounded during that time frame with Defender at a much higher level with a much lower standard deviation. So just to put numbers to it, from 2000 to 2010, Defender annualized compound annual growth rate of 9.5%. And that's just applied to the S&P 500. There's no stock picking there or anything else. And the assumptions we made about going to cash was just going to cash, not buying bonds, not buying money market that actually had any value to it. It's just assigning it as zero. So there's no benefit from holding cash other than you just weren't getting beaten down, and you had that dry powder for the next go around. So yeah, you compounded about 9.5%. You had about 30% less volatility during that time frame, and the S&P compounded at a negative 2.7% per year during that time frame. So just to give you a sense for that is what I would call like a range bound, a big range bound market, which is, it's a secular bear market. That's what you get. And in those kind of environments, that's when this program actually does its best, believe it or not. And then the other one specific while I had you here was with reference to Defender, and that was how individual investors can use this. And we do have programs for at the lower end for people who might be able to on a do-it-yourself basis, be on a do-it-yourself basis. But it's not designed for necessarily private investors, but it is available to the public, through viewright.ai.
Yeah, and real quick, I'll kind of piggyback off of Vince's answer. Stock charts, I think you can get a free, if you're looking at rate of change as the 12-month indicator or the 200-day moving average, some of those systems are easy to implement as an individual investor. And I'll segue right into a question. It says that there was mentioned 17 round trip trades, which I believe was the momentum. In 27 years, is there a concern that there are too few trades to underreact to quick regime changes? I would say, in my experience, that regime changes don't actually happen as quick as you think. There are warning signs whether momentum is going to start to stall often before the downtrend happens. Very few actual crashes occur. So I think if I think back to Jesse Livermore once said it was never in his doing that he made his money; it was in his sitting. Vince referenced that the market is biased to the upside. The beauty in these systems is not that you're trading too much. You actually want to try to be in the market as much as possible. And it's just in the really big drawdowns or when something has changed dramatically that you want to get risk. So obviously we're coming at it more from a longer term investor, how to manage risk. If you're looking at trading and things like that, you're going to want to dial that up a little bit. But I think historically speaking, erring on the side of being in the markets is kind of how these systems are the most successful.
I'm going to just jump in on one of the questions of beyond the 200-day moving average or the 12-month momentum, are there any other metrics or techniques you're exploring to enhance trend following models? So one thing I've taken the basic concept of the 200-day moving average and put a historical volatility band around it. So just because the index falls below the 200-day, I don't sell right away. I have a threshold when it's below the 200-day, what percent below based on volatility. And the same thing above, just because it moves above the 200-day, I don't get in right away. And because of that, I didn't show it on this. I just did the simple 200-day. But there's another question I'll tie into that, which was the 17 round trips. With the 200-day, there's 92 round trips, but with my volatility, historical volatility band around the 200-day, it drops to 12 12 round trips, but my return is 9.06%, and adjusted it's 12.61. So that ties into, again, we're not trying to react to all the noise. Longer band, longer momentum. If we were looking at a 50-day moving average or a 3-month momentum, you're going to have a lot of false signals, a lot of whipsaw. So it's not necessarily, again, being in the market at all times. It is being in the right regime. And with the historical volatility band I have around it, it's just made it just much more efficient. And I think that's the thing we need to look at, is the adjusted risk returns and the efficiencies, along with the psychological side of things of not being exposed to the worst days, even though we're out of the market. So what other, Ryan, do you want to take another question or?
Yeah, and real quick, I thought I'd come here because we did catch, and it was pointed out as we're on the slide, this should be 0 trades. Buy and hold, there isn't any trading. So that was a typo. The other question that I'll jump right into, it was asked, would you consider the CAPE ratio, which is the cyclically adjusted price to earnings ratio? So if I remember correctly, you're adjusting over the inflation adjusted earnings over a 10-year period. Would that over a 12-month basis be a comparison? I will say personally, of the three of us, Vince kind of went into technical analysis straight away. So in that regard, I think he is maybe smarter than Sean and I. I know I went fundamentals first, and so I'm a recovering fundamentalist. And I found that valuations do a much better job of telling you how far you're going to potentially fall, more than a timing mechanism. So I haven't been able to use fundamental data in a way that outperforms some of these trend followings, and particularly the Defender. So I try to keep the things that are built into price.
Yeah, just a question on Defender. I think you raised on slide 13. What would the trades be if Defender had a trade column there? And there were, because it's graduated, you have more sell signals than you have buy signals. But during that time frame, you would have had a total of about 40, 45 or 46 trades total, but only 10 of them were buys, buy signals. So if that's how you would define round trip, then I think you would say that I would answer it 10, right? And that's again just due to that graduated approach. We don't want whipsaws, and we're high conviction sell on the sell side, and then also high conviction back on the other side. The other question I think I'll take, but you guys can also weigh in, is that given the emotional pull of FOMO during sharp upswings, how do you maintain discipline in a rules-based system that might reduce exposure prematurely? And I guess I would just say, and this is just from somebody who's built systems and knows why I build them, is that it's basically to take the emotion out of the equation. You have to understand why you're doing it, and then you have to be confident in your testing. And that's why you test robustly and rigorously. And when you do that, you trust the process. Even when you think as a person it might be wrong, you still have to trust. You still have to trust the process. You have to trust your data. You have to trust the core concept behind the system you built. And that's why I love the fact that mine's based on breadth, because I just trust it more than anything else. And to build a system around something you really trust and that you found really works, and you've tested it heavily. And if you do those things, then sure, it'll be uncomfortable, but you have to have confidence, confidence in that system. And also, you have to build it into your system in a way to understand that bias, which is why I built it the way I did, which means that my system has a dual mandate. I want to stay maximally invested as long as I possibly can because I know there's a long-term bias to the market. I just want to avoid high probability, deep or prolonged drawdowns. So as long as I assess those probabilities correctly, and I'm moving in the direction of those probabilities based on history of 100 years, then I feel, you have to feel pretty good about that.
Yeah, and just to pick up where Vince left off talking about the FOMO, I think one of the beauties of a system that scales in and out is you're never all in and all out. When I first started doing some of this research, I would develop systems that would make drastic swings like that, and it makes it much harder. So I think incrementally is a big thing because you're only making baby step changes. And then I'll also tie in an additional question that came in was, how do you explain this approach to clients who've internalized the stay invested mantra for years? So I think there's two sides to the coin, right? There's the fear of losing and the fear of missing out. There's a lot of behavioral studies that show, pain is the pain of loss is much larger. I think 2 or 3 times larger than the joy of a gain. So I think, it takes a little time to right the ship, but it becomes an easier sell, right? Because you're going to have a little bit of fear either way. But for the most part, starting to reduce exposure when things are getting perhaps a little frothy, and then, being in a position to buy low, right? You can't buy low if you don't sell high. So I think part of it is humans are wired the way to think, the way these systems work, which is why that mantra is probably so ingrained, or, the marketing is so high on it. It largely probably is because it goes against the human nature. So I think over time, the narrative kind of sells itself. And what I've done is, I've communicated what the risk signals are to clients, so they start to see what the environment is when you get those changes. And then I've also offered, portfolios with it and without it. And so then you have a comparison. Hey, this is what happens if we're managing risk in real time compared to buy and hold. And over time, it's been my experience that people tend to prefer the risk managed version after watching it in some time. But yeah, it is. I mean, that's part of the reason why I really thought this was a great opportunity to work with some smart guys, was that, this is so entrenched. And, hopefully with conversations, it's easier because you can't just, throw up these graphs to a client and explain, you have to have a lot more of the finesse to get people to buy into it.
I just want to answer one last question. With the your data uses Norgate and Bloomberg, how sensitive are your findings to the data source or chosen time frame? So I just did, while Ryan was talking, I just ran the 200-day moving average with my historical bands around it from 1982 to 1999, one of the greatest bull markets of all time. My system did 12.38, where the buy and hold did 14.78. I was only in the market 78% of the time. Risk adjusted is 15.81 versus 14.71. 8 trades. Drawdown of 21% versus 33. A Sharpe ratio of 0.5. 12% annual volatility versus the S&P at 15.94, an alpha of 1.19, a beta 0.59, and a correlation of 0.85. So even within one of the greatest bull markets of all time, being in and out of the market on a risk-adjusted basis, there is justification to follow the rules and sticking to those rules no matter what the overall market regime you're in, or bull market or secular or whatever else. So that's just a quick observation of times of one of the best bull markets. So hopefully that gives you some ideas on, researching, creating strategies, looking at different ideas and then testing them and then saying, does this align with my investment philosophy? If it does, then you stick to it. And we're not saying one system fits all or one system is the holy grail, but at least it's a starting point.
We have another one coming for you, Sean.
Yep, Sean.
What software are you using to come up with this? I'm using AMI Broker, and I have designed, I don't know, 100 different systems in there, and I just pulled up my historical 200-day moving average and select the dates. The dates I used was January 1st, 1982 to December 31st, 1999, and compared the buy and hold to buying the SPX, not the SPY, but the SPX, and ran it. I did one from 1950 all the way up to yesterday, but I wanted to give more context of a bull market and not just, you know, a market regime where the 2000 to 2009 where the market was down, or 66 to 82 where the market was up 2% a year. I wanted a bull market to show even within a bull market, adherent to strict regime identifying strategies can improve risk-adjusted returns.
That's great. Well, I think we're kind of up on time, guys. So, you know, if anybody wants, I'm just gonna, we should each just tell everybody how to get in touch with us. And of course, the paper. Just to mention, if you want to see the real paper, the full paper, it was published in the July issue of Technically Speaking. And of course, if you go to the CMT website, CMT Association website, you'll be able to find that there. If you want to reach out to me, I'm of course on LinkedIn. I'm pretty good at being LinkedIn with a lot of CMTs, and really anybody who reaches out, I'm always happy to talk. As well as on X, it's just CMT Randazzo, and of course you can go to my website viewright.ai and connect with me that way. Learn a little bit more about what we do.
Yeah, thanks, guys. Yeah, I think LinkedIn is probably the best place to find me. Otherwise, tamriskresearch.com is my website where a lot of the research and stuff that I do will become available.
I'm on LinkedIn as well, and my website as a portfolio manager in Canada is QUOINCA.com. And thanks, everybody.
Thanks, everyone.
Thank you.
And on behalf of the CMT Association, I would just like to extend a sincere thank you to Ryan, Sean, and Vince for today's outstanding presentation. For those interested, today's presentation was recorded and it will be made available in our video archives before the end of today. If you do have any additional questions we could not get to today, or that you think of while you're watching this archive, please feel free to email them to me or any member of the CMT Association staff. We'll gladly pass them along on your behalf. That will wrap up today's CMT Association educational web series. For the CMT Association, my name is Shane Skwarek, and I thank each of you for spending the hour here with us. Enjoy the remainder of your day, everyone.